Welcome to the deep dive. Today we're plunging into the world of stablecoins.
Yeah, fascinating space right now.
Definitely. These are, cryptocurrencies built to keep a stable value, usually pegged to something like the US dollar.
Sounds simple enough on the surface.
Right. But underneath, there's this, well, pretty significant power struggle going on. You could almost call it a stablecoin war.
Between the big crypto players like Tether, Circle.
And then you've got digital wallets jumping in, like PayPal, and even the big traditional banks are watching closely.
It's heating up, and the stakes are high. I mean, how this shakes out could genuinely change how money moves around the globe.
Exactly. It potentially affects, well, anyone who deals with money.
So for you, our listener, the learner, our mission today is to cut through the technical stuff.
Yeah, we want to map out who the key players are, what they're trying to do.
Their strategies, how regulation fits in, and, what the future might actually hold for stablecoins.
We want you to get a solid handle on it without feeling like you need a computer science degree.
And there are some really interesting echoes of past tech battles here. Surprising parallels, actually.
Okay, let's start with this idea of stablecoins becoming maybe the operating system for money.
It sounds grand, I know.
A little bit.
Yeah.
But think about those platform wars we've seen before, like Uber versus Lyft.
Or HD DVD versus Blu-ray.
Even going way back, VHS versus Betamax, those were intense fights for dominance.
Right. And what's key there, especially with VHS and Betamax, is that the, let's say, technically better product didn't always win.
Betamax had better picture quality, supposedly.
It arguably did. But VHS won out. Why? Well, things like having more movies available, cheaper players. It was about the ecosystem, the applications, not just the raw tech.
Accessibility and network effects.
Exactly. Execution applications that often matters more than just having slightly better tech. And that's a lesson for the stablecoin wars, I think.
Makes sense. So if we look at blockchain now, Bitcoin, Ethereum, they've kind of emerged as the main infrastructure layers, right? The base tech.
Largely, yes. The dominant designs, you could say.
But this stablecoin battle, that's happening on top. That's the layer everyday people will actually interact with. The user interface, maybe?
That's a good way to put it. And stablecoins are so important because they act as this bridge.
Between crypto and traditional finance.
Precisely. Most cryptocurrencies are just too volatile for regular financial stuff, for contracts.
Right. You can't price a mortgage in Bitcoin easily.
Not really. Stablecoins solve that problem, offering a digital asset with, well, stable value.
Okay, but regulators are definitely watching this. They get how important stablecoins could be.
They do. Our sources highlight that without stablecoins, blockchains would have a much harder time competing with the existing financial rails.
But they also see risks, right?
Oh, absolutely. Potential risks, like stablecoins challenging the bank's role, maybe being used to get around capital controls or AML rules.
AML being anti-money laundering.
Correct.
Yeah.
And even potentially causing bank instability. Remember the Silicon Valley bank wobble?
Yeah.
USDC briefly depegged?
I do. That showed the potential systemic links.
It did. Which brings us to how the big institutions are reacting. Think back to, 2019? Facebook announces Libra.
Conceived by one of our source authors, interestingly enough.
Right. And even though it probably wasn't going to become a world currency overnight,
the reaction from banks, from regulators, was swift and very negative.
Overwhelmingly negative. And Libra eventually folded in 2022. It was a clear signal.
A warning shot. Don't mess with the established order too much, too fast.
Exactly. And it bought the incumbents time. Now you see giants like JP Morgan Chase doing the classic, embrace, extend, extinguish.
Ah, the old Microsoft playbook.
Kind of. They're building their own blockchain, their own programmable digital dollars. It's a defensive move, but also potentially offensive.
They're using regulation to their advantage, too, right? Slowing down the disruptors while they build their own thing.
Regulation definitely gives them leverage that tech startups don't have. It's different from the browser wars.
Interesting contrast with, say, Elon Musk's original idea for X.com.
Before PayPal. Yeah, he envisioned this universal financial app.
But it morphed. PayPal focused on working with the existing card networks, the banks.
Which helped it grow incredibly fast, no doubt.
Sure, but it also meant the underlying system, the card networks, the banks, didn't really get disrupted by the internet in the way other industries did.
2 decades on, and Visa and MasterCard are still dominant. Traditional banking is largely intact.
So stablecoins are like round 2, a second chance to maybe reform things.
Potentially. but it really hangs on what regulators decide to do.
They could write rules that basically lock things down for the banks, right? Keep innovation contained.
That's a definite possibility. Which leads to the big question, what does the market end up looking like?
Do we get a couple of huge global stablecoin players dominating everything?
Or do we see loads of different stablecoins basically becoming a commodity, like different brands of digital dollars?
The tech could support either outcome, you're saying.
Pretty much. It really comes down to the strategies of the players involved.
Okay, let's dig into those players. The crypto natives first. Tether, USDT.
The OG, really. Started about 10 years ago for crypto trading. Still massive market share.
But lots of questions too. Offshore, concerns about reserves, compliance.
Yeah, the UN has raised flags. Even JP Morgan has commented. As rules tighten, that's a challenge.
Still, they have scale. They're integrated everywhere in crypto trading. And they serve markets that need USD access.
That's a double-edged sword, though. That access point is also a regulatory risk.
Right. Okay, then there's Circle, USDC.
Tether's main rival. They operate more within the U.S. system, state licenses.
But the federal regulation piece is uncertain for them, especially since they tried to go public.
Very uncertain. A key issue is KYC, know your customer. They don't necessarily apply it to everyone holding USDC. Regulators might insist on that.
So they could end up needing to become more like a bank, which might slow their growth.
It's a possibility. They're navigating tricky waters.
So for both Tether and Circle, it sounds like the game is adapting to stricter rules without killing their business model.
That's the tightrope they're walking. How do you stay compliant and make money? Tighter rules mean more costs, maybe fewer options.
Navaxos is different, you mentioned.
Yeah, their strategy is interesting. They're not pushing their own big branded coin so much.
They're betting on a future with lots of stablecoins.
Exactly. They're positioning themselves as the infrastructure for other brands, like they did with PayPal for PYUSD.
And for a payment coin like PYUSD, market cap isn't the main thing.
Not really. It's total payments volume, TPV, how much money is actually moving through it.
And PayPal, with all its merchants.
Could potentially overtake USDC in actual usage pretty quickly.
Yeah.
Even if the market cap is smaller initially.
Wow. And imagine if Paxos does deals with, like, Starbucks, Walmart, Amazon, Target Red Card.
Right. You could see stablecoins almost becoming like branded loyalty points, but interoperable. That could seriously challenge the card networks.
Interoperable because they're on open blockchains.
Ideally, yes. And if regulation makes sure they're all similarly safe?
Then maybe the specific brand doesn't matter as much to the user. It's just digital dollars.
Exactly. Kind of like how we view deposits at different banks. Now they're basically interchangeable because the Fed clears transactions between them.
And that scenario, our source says, is doomsday for Tether and Circle.
It could be tough for them, yeah. If it becomes a commodity game, their early lead might not matter as much as pure distribution power.
So what do the traditional banks want?
Well, it seems they'd actually prefer this world with many stablecoins.
Because it looks like the system they already know. Different banks, different deposits, but all cleared centrally.
Precisely. It lets them keep their roles. JP Morgan handles the big institutional stuff. BofA does retail. The hierarchy remains.
Okay. And Visa, MasterCard, they probably don't want to issue their own coin.
Probably not. Antitrust risks, plus it might annoy the banks they rely on.
So they'd rather just add support for multiple stablecoins, like adding another currency.
That seems more likely. Trying to get banks to agree on one single bank-backed coin sounds, well, like Libra all over again. Complex.
What about big tech? Google, Apple.
They learned from Libra, I think. Avoid direct fights with financial regulators.
So partner with banks instead.
Seems more probable. They control the phones, the distribution. They can leverage that whoever's stablecoin is underneath.
Okay. And neobanks? Crypto exchanges like Coinbase or Binance.
They might have bigger disruptive dreams, but they'll also face more scrutiny as they look more like banks.
But maybe pure play issuers like Coinbase, Binance could become major players. They have users, tech, some regulatory experience.
Definitely potential there. They might be more nimble than Tether or Circle in adapting.
So pulling this all together, it sounds like, just like VHS versus Betamax, this isn't just about who has the best tech.
Or who is first.
It's about the applications, where and how these things actually get used.
That's a key battleground. Regulation can shape it, slow things down, but probably can't stop innovation completely if there's real demand.
And the most likely outcome, according to the sources.
Probably lots of stablecoins kind of running invisibly in the background.
Making payments faster, cheaper.
That's the promise. A win for consumers, for businesses, even if it means the original big stablecoin players eventually get bought by banks.
Which isn't failure, necessarily. More like integration.
You could see it that way. Their tech and users get absorbed, maybe speeding up adoption within the traditional system.
But even if that happens, the fight for our digital wallets, that continues.
Oh, yeah. Who controls the Pay With button? That's still up for grabs. Credit cards, neobanks, crypto exchanges, they'll all be fighting for that spot.
And maybe the neobanks and crypto exchanges are the ones most likely to bring something truly new to payments.
They certainly have the potential to shake things up more fundamentally in that world of easy digital dollars.
Okay, so wrapping up this deep dive on the stablecoin wars, it's clearly a super competitive space right now. Big implications.
We've looked at the different strategies, crypto natives, banks, tech giants, all playing different games.
Regulation is absolutely crucial in deciding how this unfolds.
And the likely end state seems to be multiple stablecoins, interoperable, maybe invisible, driven by real-world uses.
Just like those old tech platform wars, the focus shifts
Yeah.
away from the tech itself.
Towards the user experience, towards adoption, how regulators manage that balancing act, innovation versus risk, that's going to be critical.
Will stablecoins really disrupt or just become a slightly better version of the status quo? That's the question regulation will help answer.
Exactly.
So a final thought for you to ponder. In that future of seamless digital dollars, who do you think actually wins the pay with battle? And what new ways to pay might emerge that we haven't even thought of yet, beyond just having a card or an app?
It's definitely a space to keep watching, constantly evolving.
Absolutely. Thanks for taking this deep dive with us.